Hello everyone, welcome to our another episode of Working with the Expert. In this podcast, we are going to discuss it's not about how much money you make, it's about how much money you keep. Yes, this is very important even you are a real estate investor or you are a realtor, first time home buyers, whatsoever. Taxes is the most important component. So it's all about money. Let's welcome our guest for today, Cherry Chan, an accounting expert from the team Real Estate Tax Tips, right? Welcome, Cherry.
Thanks, Mandeep, for having me.
Yeah. Thank you. Thanks. And thanks for taking your time out from the busy schedule. I know you have back-to-back presentation. So before we dig into the tax, everybody I know will be excited how to keep more money into their pockets. Why not we get to know who is Cherry Chan?
Sure. My name's Jerry. I am a chartered professional accountant. In the old days, they call us the chartered accountant. I'm dating myself a little bit because CA has gone out of not gone out of business, but it has merged into CPA for a while now.
Okay.
I graduated a number of years ago from Waterloo and then got my license. And I always found that working for someone else in a big corporation wasn't as satisfying. So then I started investing in real estate as a side hustle, and then I started wanting to venture outside of my comfort zone and start my business. But at that time, I already had a house, and the reason why I would be able to take the leap was because I had an investment property that generated like $700 or $800 of cash flow, and that's how I decided to take the leap and start my own business as a result of my investment property.
Love that, right? So you went into investment, you started from University of Waterloo investments, and then you went into taxing. I know, like, do you had any challenges like as a woman entrepreneur? So many things you're doing. Like, do you had any challenge like that in your life? You have said, "Oh, I could have been better if it could have been men or something." Have you been faced those issues like that?
Yo, absolutely. It's not just woman, not woman. I think human as like with color, minority, we all face different type of challenges. Like as women, I had my babies. I gave birth after I quit my job, so then naturally I had no EI, and pretty much I worked through the entire post pregnancy. Just like anyone else that's struggling out there, my competition are always, for lack of better terms, men in their 40s, primarily white. And
Mm,
those are my competition. Is it easier or more challenging? I've never taken the approach that, hey, just because they are certain ethnicity or certain background, it's more challenging for me. I've never taken that approach. I've always just focused on my own lane. For better or for worse, I only focus on my own lane, and this is what I'm going to do, and I just keep fighting through. So, is it more challenging? Potentially, but I I'm not a white male in my 40s, so I don't know how easy or not so easy for them. I've always heard from my colleagues from Deloitte, where I used to work at. One of the Deloitte is still the largest accounting firm in the world. They said that, oh, it's so much easier for you, Cherry, because you are a woman, you are a woman of color, so you're minority. So for you to stay at Deloitte, you would be made partner because of your color, your skin color, as well as because you're a woman. So that they also feel the same pain. So I don't know what's right
mm.
and what's wrong anymore.
Love
What
that
about
actually,
you?
Yeah, no, I completely relate to that. So you were saying you were really focused on what you're doing.
Mm-hmm.
So that it doesn't matter what is happening because what I feel too, I can relate to that. There are so many distractions. I always say these are distractions happening around you, and that'll always be there. It doesn't
Mm-hmm.
matter which color, which country you are. No, you go to India, you go to China, you go to US, Canada, whatever, right? So still you have those problems. It's how your mindset is. So initially, what I feel is like even for you, we had the same issues. Like I'm wearing turmeric on my hand, had right. So I had those issues. Like I felt like insecurity. I'm the odd one out. I can be easily pointed out. But now I'm so much adapted to the system. I think it's someone is like doing something. It's not. It's none of your business. You just focus on your work, and I feel People here are more adjusting. They are very adaptive because we are all immigrants here. That has really helped. Actually, Canada has given us a lot of opportunities as such, and things are changing. Maybe for your kids also, for my son also, they are adapting too much into the system. So they are already there. For them, it doesn't matter what color you are, what caste you are, what language you speak. That doesn't matter. And for what I felt is being outside of Canada, my education is also outside of Canada. I never interacted here, so I had those challenges definitely, but I have adapted as of now. Because let's say we approach you, right? So let's say Cherry on our network. Obviously, our clientele is totally different. We're very open and upfront, but we took that initiative. Why not be like collaborate with other people? It's not about you, it's all, we are all together going together. And I feel educated people have their own mindset, they have their own authenticity, they have their own color, they have their own language, so they respect. So I can relate to that. I know, I think that's another topic to discuss on the side. People are waiting about Cherry Chan about the taxes. So most of the time we hear the question, corporation or sole proprietorship, which one I should go for? What are the pros and cons of that? Let's say I am into a logistic business. Shall I go with a sole proprietorship, continue what I've been doing, or I should go with a self-employed, it's self-employed, open my own corporation? What are your thoughts on that?
You're talking about a business, logistic business, right? It's not has
Yes.
nothing to do with real estate investment. Yes.
Yeah, just an example, right? Just an
Yeah.
example. Yeah.
Absolutely. That's a great example. I like it a lot. Now, so the number one thing is that people have to understand, and I'm sure this is universal all across the globe, is that corporation is considered a separate legal entity. What it means is
Hmm.
that it can sue and be sued on its own. It can go out and sign, I mean, you sign the paper, but it can sign and enter into an agreement as well as sign off on loan on its own. So that's very important because what it also means is that if it goes bankrupt one day, not on
Okay.
it would never do that, but if it goes bankrupt one day, you as a shareholder of the corporation would not be affected unless you personally guarantee some of the loans, and that's a different story because then you voluntarily sign away some of your
Okay.
protection. But
Hmm.
that separate legal entity on its own provides you a lot of protection. What people don't understand is that, like, when you own everything in your personal name, everything in your personal name is affected. Your own home is being affected. Your car that you
Hmm.
own could potentially be jeopardized and be exposed to the same business risk. That's number one. Now, number two is that in Canada, our Canadian personal income tax system is on a progressive tax system. What it
Yes.
really means is that the more income that you make, the more tax that you would have to pay. Between $0 to about $46,000-$50,000, you pay roughly 20% tax, and then 46 to 50,000, you pay 24% tax, and then it keeps going up all the way to over 230,000. You pay 53.5% tax. What does that really mean?
Hmm.
Anything over and beyond that $235,000 ish, for every $10,000 more, you
Hmm.
CLA gets to keep 53.5%. You get to keep less than what CLA get to keep. Is that fair? Well, there is no right or wrong. Like, that's how we are. We chose to live in Canada. But one thing that the corporation offers you is that if you own the business and net anything under $500,000, the small business deduction, assuming you qualify, then you are paying only 12.2% inside the corporation.
Okay.
12.2% is 10,000 times better than 53.5%.
Hmm.
Now, going back to your question, like, should someone set up a corporation immediately? Well, it goes back to your risk tolerance, the type of business that you're in. Like, for some of the business, logistics business, 100% I would set up a corporation from day one, just because, there's risk exposure. Some people who are doing very small, like they have very small risk in their business. For example, some people who are content writer, not significant amount of risk, there may be less reason to immediately start the business. And a lot of people operate with the mindset that, hey, it's a small business. It's not really going to go any bigger. I might really just have a job in a way. A content writer could be, or marketing expert could be making $150,000. And they need all the $150,000 in their world after paying taxes to pay for their own expenses. Then there is no point setting up a corporation, because when you take money out from your own corporation after paying the 12.2%, you still have
Yes.
to pay some amount of personal income tax on the money that you draw out from your corporation. Remember, the corporation is a separate legal entity. You pay the corporation tax. You can leave the money there. You don't do anything with it, with the
Okay.
excess money. But as soon as you take the money out, excess money out into your personal name, then you have to pay personal tax. Now, if you need to take all the money out from your corporation to pay for your own personal expense, from a tax perspective, there is no saving at all. But if you are able to, let's say you have $100,000 left in the corporation and you only need $60,000, then you take out $60,000 from the corporation and leave $40,000 in the corporation for you to invest and grow your business. Then there is a reason, because it gives you flexibility for you to save taxes and defer taxes.
So makes sense. It's basically on it's case to case basis, obviously, and it depends on whatever retention you want to have in the corporation, whatever investments you want to do, and obviously it's 12.5% the corp tax and on the full tax that you have to pay as a sole proprietorship. Now, if we switch gears, let's say we want to somebody want to buy a property. So is it recommended to buy property on the personal name or on the corporation? Like it's on the investment side of it. What are the benefits out of it? Same like sole and the corporation, or it's different?
So it also goes back to a bunch of questions. And I do
Okay.
have a report that lists out all the criteria that we look at. You're welcome to go to my website to download the free report. But just to name a few, the first thing is that
Yes.
depending on the type of investment strategy you're thinking of, like if you're thinking of, hey, I am doing flips in general, they are considered a business because you're actively managing and reselling the property. They're considered active business, and therefore the sale of the property is 100% taxable. Now,
Yes.
so that means if you buy 500, put in 100, so now you're $600,000 into a property, you sell it for 700, you make that additional $100,000 profit, 100% of it is taxable, and
Yes.
100% of it will be added to your personal income if you add it, you report it in your personal name. But if you were to do it in the corporation, then that same $100,000 would only be subject to
Okay.
12.2%. So it is a lot better. If you are doing flips or constant flipping of assignment deals, wholesaling, land development, land severing, all these like active type of business, real estate investment, I would always recommend my clients to put it in the corporation. Now, beyond that, if you're just simply, hey, I'm just one of those people who just want to retire with a couple of properties and I'm doing long-term rental, then it depends on your particular situation, where your money comes from on these properties. You might be a realtor like you, and you have your own personal real estate corp, and you
Yes.
earn all your income in the corporation and pay only 12.2% tax. And now if you were to take the money out from your corporation to your personal name to invest in these properties, you have to pay another layer of tax. But if you
Yes.
leave it in the corporation, um, leave the money, retain earnings in the corporation and invest within a corporation structure, then there is no personal income tax involved. In other words, if you already have a small business set up, making good
Hmm.
money, you have retained earnings in that corporation, you can turn around and use that high retained earnings and invest in a corporation as well. Those would make sense to invest in the corporation, even if it means that there are only a couple of properties that you are investing in. So those are
Definitely.
scenarios.
Oh,
And then
definitely.
the other question is, the other questions that we normally have for our clients is, hey, how many properties are you planning to buy? So if you're only planning to buy one downtown Toronto condo or one Mississauga
Yes.
condo, the risk profile of that property is, it's not that big, especially if you focus on the high end market. So then you don't really
Hmm.
need to worry about risk, and you're only planning to buy one, then realistically, from a cost perspective, buying a Toronto or Mississauga condo that don't generate a lot of cash flow, but there are upside, doesn't really make sense to set up a corporation. But if you have a big plan, hey, Cherry, I'm going to buy 10 properties in the next 10 years or 5 years.
Yes.
There is more reason to set up a corporation to protect yourself, as well as providing some tax flexibility, planning flexibility with a corporation. And then the next thing is also the mortgage qualification. Sometimes the bank look at you differently when you buy properties in the corporation, even though you provide a personal guarantee
Guarantees.
against
Mm.
the mortgage. The personal guarantee would still get registered in your personal credit report, but when they look at that personal guarantee, some banks may or may not look at that personal guarantee as an additional property registered in your name, so then they don't use the debt servicing ratio to calculate toward your next property's qualification. So it helps you to get more mortgages in the long run. Those factors matter. Now, the last thing that I always talk to my client about is how likely are you going to also give your properties to your future generation? The main reason is because more often than not, as they planning, as they freeze, involve something called corporation. One way or another, there's some transfer of assets from your personal name to the corporation. But if you already have the corporation set up, then there is no transfer needed. When you have to transfer any assets from your personal name to the corporation, properties-wise, in Ontario properties, you have to trigger that land transfer tax, which costs a fortune, right? Especially for properties that are within the boundary of City of Toronto, you have to pay double land transfer tax.
Yes.
And that makes it really challenging. I mean, I also personally have my own home from 2011. I still own it in my personal name because at the time it was my own home. And I had been having trouble to transfer it over to my corporation because I knew that I would be paying double land transfer tax.
Mm-hmm. It makes sense. So you were talking about passing that investment to our kids as a legacy. So in that case, you're recommending it's better to have a corporation structure so that can be easily passed down rather than being on the personal name also. Just correct me on that.
So when you have kids, the easiest, and if your plan, your plan already, the easiest is to have a family trust. I do this because in our world, triangle represent family trust on Excel workbook.
Yes.
But the easiest is to have family trust. Then for sure, it could be guaranteed that your shares of your corporation would be given to your kids on a tax-free basis. But the challenge with having a family trust as the shareholder of the corporation is that you may not be able to get financing. So typically, our clients start off having just the corporation.
Okay.
And the shares is owned by them. And later on, over a period of time, they slowly move the shares of the corporation to under the family trust. Now, there is still tax implication. You don't have to pay tax immediately, but you freeze the value, and therefore that capital gain belongs to you, the original shareholder, and therefore you would be liable if you were to sell the shares or if you were to die tomorrow, then that capital gain still follow you. But the future capital gain would be given to the beneficiary of the family trust, and beneficiary of the family trust would be your kids.
Definitely. I think we can have a long discussions on this just for the time's sake. So recently there were so many tax regulations that came into picture. Anything specific you want to talk about related to real estate investors or first-time home buyers? That'll benefit them. Like I know there's were anti-flipping rule, there were other regulations. Anything you want to highlight them?
Yeah, so there are so many of them. I'm sure you've heard a lot, and I did. I think I did a video on all the tax changes that are happening in 2023, and that's not all comprehensive either. So to name a few, the anti-flipping rule just came into effect January 1st, 2023. For any closing that happened within 365 days, any sale that happened within 365 days after you purchase a property, the profit that you make would be automatically deemed to be business income. 100% of is taxable. Generally speaking, people have this misconception that when you own one property or when you own any property and you sell it, you turn around to sell it, you either don't have no tax to pay because of primary residence exemption,
Primary.
or
Mhm.
you only pay capital gain tax. Only 50%
Mhm.
of the profit would be taxable. But now CRA says no, this is not the case. And by the way, we want to help you make it easier and also help them easier to catch people who are abusing the law. We're going to say that 365 days is the cutoff day immediately. Anything, and for any profit that you make after owning the property for only 365 days or less, all of it is business income, 100% taxable. So that's number one rule change.
Definitely. So I have a question. Sorry to pause you here on this. Does it applies to the prime residents also? Somebody was selling the home which they were living after 200 days. Still they have to pay tax, or it's still exempted?
Yeah, so this exactly would be the primary residence exemption would still fall under the same rule. Now,
Okay.
Now, there are some exemptions that would allow you to escape from this rule. This could mean that you get fired. You may want to get fired if you really make a fortune and don't want to pay
Okay.
tax, and then you may want to get fired somehow. Like getting fired, there is court order, there is like safety issue that you are concerned about. Someone is joining your family or leaving your family, so like you're getting
Okay.
married, or like you have a new kid, or your parents are joining your family. Those are like specific exclusion that would allow you
Okay.
to get exempted. But let's say you just hate the neighborhood or hate your neighbor, because whatever reason why you hate the neighbor, after you move in, you decided to sell it within 365 days. You legitimately moved in and use that as your home, and you really just hate your neighbor, and you decided to sell it within 365 days. Sorry, any profit that you make is still considered business income.
Okay.
Mhm.
Makes sense. That's a good
Unless you
point,
get
right?
yourself fired.
Yeah, so there are obviously exemptions, but that's a good point. So let's continue. We were talking about the tax new regulations.
Yeah,
So
so then
anti-flipping, yeah. Mhm.
there are a bunch of vacant home tax that you would have to file. I mean, it's already, we passed the deadline for the City of Toronto vacant home tax reporting. The
Yes.
Ottawa one is coming up. I think it's March 3rd or March 23rd. I don't remember off the top, but that one has to be filed as well. And these are just two of the vacant home tax. Of course, there are Vancouver people as well, and they have BC, the province of British Columbia. They also impose a rule, and then some other city government are also considering the vacant home tax in their own city. York region is considering that as well. So those are the new rule coming down the pipeline, but hasn't been effective. Now, another thing that is the third thing, which I don't think I spent a lot of time in my previous YouTube video or in any of my previous webinar that I
Podcast, right?
did.
Yeah.
Yeah,
Yes.
it's because the form hasn't been released, and now the form has been released, and I have to
Okay.
talk about it. It's something called Underused Housing Tax Act.
Okay.
It's a
That's interesting.
federal law that's
Mhm.
very similar to the vacant home tax that you've heard about, but it's a federal law, so it applies to Canada-wide. And essentially, the goal, the purpose of the law, the legislation, is to prevent non-resident and non-Canadian citizen owning homes, residential properties, and leaving them vacant. That's the overarching objective. Now, but the law that's being written out, as it turns out, it applies to a lot of Canadians, especially for those who own properties inside a corporation. Even though you may not be dinged on the tax amount is 1% of your assessed value or a higher of your assessed value or fair market value.
Yes.
And it doesn't, you don't need to pay the tax if you own properties through a corporation, but you still have to file the form. You have filing obligation. You don't have the liability, tax liability, but you need to tell CRA, hey, I own this property, I'm exempted, but you have to tell CRA. And if you don't do this reporting, you will be dinged $10,000 per form if you own the property in the corporation. Now, there are situations that it would also apply to, for example, it would also apply to individual, even though they're Canadian. If they own a property that they own in trust for a corporation, they have to do the filing. If they own the property on title, very common, husband own the property 100% for financing purpose. The wife does all the work because she stay home mom, and the kids go off to school, and during that school time, she does all the property management. So then on paper tax return, it's husband and wife reporting the income and expenses, assets and liability, but on title, it's really just the husband. Very
Okay.
common. And if that situation applies, the husband has a filing obligation, even though it's not a formal trust, it is an informal trust, you still have that filing obligation. So it could be very affecting a lot of people, and they're not even aware that they have the filing obligation.
So that's already been implemented. So this means by next year when they're filing the taxes, they have to see
No.
this form. Yeah.
So yes, it has been implemented since January 1st, 2022.
Oh, okay.
Yes, the form was just released January 31st, 2023. So 2 weeks ago.
So this means anybody who's going to file the taxes for 2022, they need to be mindful. So they need to
Yes.
work with experienced accountant who knows about
Yes.
it, who can educate about them. At least they are filing those. Oh, it's a good point to
Yeah.
talk about, right? So that's a good one, right?
The deadline to file is April 30th.
Yes, obviously. So yeah, hopefully
Mm.
people are watching this podcast, they know, right? So
Yeah,
from this,
absolutely.
so yeah, so Cherry, right? I know so a lot of people who are watching this podcast. They are most of them are like, let's say, working 9 to 5. We
Mm.
talked about so much about corporations, sole proprietorship, anything for them where they can save from taxes. Any tips for them?
Yeah, so for folks that
Full-time
are
employees.
full
Yeah.
time, that work as full-time employees, unfortunately our hands are usually tied. There are only a few tricks in our bags that we're using to lower their taxes.
Yes.
Obviously, when you invest, there are ways to deduct all the expenses. At least you're earning some income from your property. You can write off all the expenses, including the line of credit interest that you borrow against your own home to invest. Those are a given. If you want to find out more about what you can deduct against your property, by all means go to my website or go to my YouTube channel. But like generally speaking, there are only a few things that we can do when you are
Mhm.
a full-time employee. The first thing
Mhm.
is RSP contribution. I know it is an old way of investing, but what people don't understand is that there are tricks that you can use with your RSP contribution. For example, contribute to your lower income spousal contribution. So eventually, when they take it out, it would be in their name, in the lower income spouse name. It gets split over two people to do income splitting. Another thing that we could talk about is you could do is take advantage of the TFSA contribution. I think now is over 80,000 if you've never contributed and you are a Canadian resident back in 2009 and you qualify over the age of 19, you have over $80,000 to invest within your TFSA. And you can give the money to your lower income spouse to invest in their TFSA account too. So there's like a pool of over $160,000 for you to invest tax free. Those
Okay,
are the
that's a good
options
one.
available. And then and again, depending on your particular situation, there are other different type of tax-free incentive or tax incentive that would allow you to buy your first home. The first home saving account is coming out. You would be able to
Yes.
contribute about up to $40,000 in your lifetime to that account. The contribution to the account is tax deductible like a RSP. The withdrawal of that from that account, provided that you meet the definition for use the fund to buy your first home, would be completely tax-free. So it's similar to the withdrawal from your TFSA account. So it is great tax incentive available for first-time home buyer.
That's
There's
good.
the first-time home buyer tax credit has increased. I think was increased to $2,500. And so that's something that you should claim if you're buying your home the first time, and you're moving in the first time. You should be able to claim that. Then there is also obviously the land transfer tax that they can get exempted, or like there is a land transfer tax credit if you're buying your
Yes.
first home. Those are the basic. And then if you are working from home these days, don't forget to claim your home office expense. And if you're using your vehicle for the purpose of running around for your own employment, make sure that you get a T2200 from a form T2200 from your employer to specify that you're required to run around using your own vehicle for employment purpose, and you would be able to write off a portion of your vehicle expense as well.
Definitely. So basically, there are some room available for the full time also. I like the concept like full time employees or your vehicle write off. That's a option. We talked about the first time home buyer benefits also. So that's a good one, right? So now let's say some coming back to the corporation structure again. So it's always recommended to work on maybe a contract basis or in a corporation. Obviously, you have better write-offs available. One of them we already talked about, 12.5%. What is the other benefits you have working on a corporation? It's more of an employee thing. Apart from this,
From
like work.
So as in having a corporation owning, running your business in, right?
Yeah, business or you are employee, right? So basically, you're a contractor now. You were a full time before. So what are the benefits in this case? Let's say we have a lot of professionals who work rather than doing full time job, they transfer into contracting. So what are the
Mhm.
benefits for them?
So when you're a full-time employee, a lot of the stuff you have are provided by your employer. When you are a contractor, essentially you're running your own business. Now, provided
Yes.
that you don't break the rule to be a personal corporation, personal services corp, because personal services corp means that you're an incorporated employee. You get taxed at the highest tax rate. So you have
Hmm.
to take precaution steps to make sure that you don't break that rule. Now, assuming that we don't break that rule at all, you're truly operating a business. So anything that you incur for the purpose of earning that particular income would be tax deductible. So this includes your home office expense. If you use your
Okay.
vehicle, it would be tax deductible. If you have office supplies, your internet, your website, advertising expense, your computer expense, your cell phone expense, these would be all tax deductible, assuming that you use them for the purpose of running your business. Your QuickBook Online account, your accounting fees, these are all tax deductible. Now, if you also take your clients out or referral source out for a dinner, that would also be tax deductible, as long as you are able to provide a cause and effect relationship for the expense incurred. So the cause is incurring the expense
Hmm.
and earning the income. As long as you have that relationship established and you think that it is completely incurred for the purpose of earning the income, assuming CRA doesn't have an exemption from it, you would then be able to deduct it and offset against your income and pay less tax on the net income amount.
Definitely. So there are more benefits available as a contractors. So you are into this accounting business. So
Mm-hmm.
when you are filing taxes, like you must have seen like people who are working. So there are some trigger points. Trigger points in the sense for the CRA for doing an audit on that file. So is there any secret sauce that you want to share on this podcast? What are those trigger points? We already talked about like you're doing maybe you might be doing extra write-off for your vehicle or for gas or stationery. So that might be trigger points. But what are the common trigger points for the CRA to go into audit?
So it depends on your industry. For a
Okay.
lot of the clients that we work with, we primarily work with real estate agents as well as real estate investors.
Yes.
In particular, for real estate investors, I'm sure you've heard a lot about it. Since 2015, CRA has been putting a focus on auditing people who invest in Ontario and BC, and since 2015, they've recovered over $1 billion in tax revenue
Wow.
in the province of Ontario alone. I think another $1 billion in British Columbia. And the audit that they go through, they really focus on people, first of all, people who are not paying tax at all. in terms of like buying and selling a home. They would claim that they move into it briefly and they're using it as their primary residence and not reporting the sale at all. So from 2017, 2016, 17 onwards, CRA already require you to report the disposal of your primary residence. Now, does that mean that there is no people trying, there are no one trying to take advantage of the rule? No, like they're still taking advantage of the rule, which is why the 365 days is being brought in. Now, that's one thing. The other thing is people report the sale of property, even though they flip it, it's meant to be reported as business income.
Business
Now
income, okay.
they report it as capital gain.
Capital.
So the reality is that there is about 12 to 16 criteria that CRA go through and look at every single transaction and see if it falls under the business income side or falls under a capital gain side. And based on that discussion, the decision and analysis, then usually CRA would take an aggressive approach and say it's falling into the business side, therefore the profit would be 100% taxable. Those are also another hot topic that CRA is looking at. Another thing is HST. HST, especially in Ontario, is huge, especially on new home. They have recovered a lot of money from people claiming that without knowledge, being misled into signing off that they are moving into the property. And so then they can claim the HST rebate. So for some of the people who are buying pre-construction home, what people don't understand is that the sticker price that's posted by the builder, they include a full 13% HST. But what the government offer Ontario resident is that there is a rebate available, and the rebate is about $24,000.
Yes, yeah.
Yes. And so the price is the full purchase price, the sale price, plus 13% minus the $24,000. That's what you see as the net amount. What people think is that, hey, like if I sign off saying that I'm moving in, I don't have to pay HST at all. So I paid a lower tax. The reality is that you just pay $24,000 less, that rebate. Now, so when you claim that you're moving in, but you're not truly moving in, CRA would catch you because your tenant is going to report something different. You're going to report a sale if you sell it, or there is a way to track it, and therefore that HST, they audit you and saying that, hey, like you cannot sign off to move in when you're not. And if you sign off to move in at closing, but you did not, and instead you turn around and rent it out, you're still eligible for the same $24,000 rebate. It's just that the way to file it is to pay extra $24,000 to the builder. Don't sign off on moving in, and you turn around and claim it using the proper form. The turnaround is about 3 months, and you incur 3 months of interest costs on it, which is nothing. But CRA has been targeting these a lot. Another thing that CRA also targets is cover the flipping. We cover CRA. If anytime you get money back from CRA HST department, you will get audited. And those are where things are. And then another thing is if you report multiple years of losses from your if you report multiple years of losses from
maybe a rental property, maybe.
Yeah, rental property, or if you have a side hustle, a sole proprietorship gig, but you report multiple years of losses and not showing much income, they would also audit you.
Very valid point, right? So just on a follow-up question on that, what happens if we have a rental property? Whatever write-offs we can have, obviously there's interest write-off, is there property tax, or is it utilities, or there are some repairs? What all the write-offs we can take as investors that are very, as per the legit route, as per the CRA?
So a few things. Like I mentioned before, the line of credit interest if you borrow against your line of credit
Okay.
to use as a down payment. There's the advertising expense if you were to lease it out and you incur Kijiji or Facebook sponsorship, or you pay a realtor to fill the property. Those would be a one-time write-off.
Yes.
Another thing that people don't often talk about is the vehicle expense. If you are driving your vehicle to manage your property, the proportion amount of automobile expenses would also be deductible. Home office expense is also tax deductible against earning rental income, provided
Yes.
the documentation for it. Um, I think those are big one. Oh, finance charge. If you purchase a property with less than 20% down and you rent out the property, you typically are required to pay CMHC insurance.
CMSC. Hmm.
And CMHC insurance are tax deductible over 5 years, even though you pay into your CMHC insurance by adding the amount to your mortgage. So you pay it through the 25-year
Yes.
amortization. But the actual
Hmm.
amount will be tax deductible over 5 years.
Makes sense. A good point, right? What about the land transfer tax,
So
lawyer fees?
land transfer tax and lawyer fees are not tax deductible immediately. It's being added to the cost of the purchase. So when you like, let's say you purchase a property for 500,000, and there is like
Mhm.
$10,000 land transfer tax and the lawyer fee total. I know I'm picking a random number here; it's not
Yes.
accurate, but
Mm.
let's say it's $10,000 in total. Now your purchase
Yes.
price is not 500; it's $510,000. So when you sell it for $600,000 3-4 years down the road, your capital gain is not $100,000. Your capital gain is 90,000. You take 600 minus the 510. So
Hmm.
it's worthwhile to mention that people often think that, oh, I can write off the land transfer tax. You can't write off the land transfer tax.
Okay, that's not possible. Actually, we have some questions coming up, right? So I posted a story, right? So hold on, I just wanted to see it off. So there's a question, right? HST, how I can get it back? What are the conditions to get it back? It's about HST.
Uh-huh.
So
So
how we can get the, yeah.
the HST, we're talking in the context of buying a brand new home. If you're talking about HST purchasing a brand new home, and assuming that you are moving in, then you can just assign the right to claim the rebate to the builder. You pay the lower
Okay.
tax. Now, if you are renting it out and using it as a rental property, and it is being occupied by someone that's not related to you, then you, with a 1-year lease agreement, you can fill out the form. I think it's called new residential rental property rebate form. Fill it
Okay.
out
Okay.
and then submit it to CRA together with your lease and statement of adjustments. The closing document is specified on the form what kind of form that you would have to file, and then you submit it to CRA. The turnaround time is about 3 months, and you will get your $24,000 rebate back. Now,
Definitely.
let's say if you are building your own new house, that's completely different. You are the one that's paying your contractor lots of HST. Your builder, your contractor, your plumber, you also are eligible to claim a portion of that HST back. And
Okay.
that's under the new home, I think it's new home buyer, new builder home form, something like that is also rebate. But you need to have solid documentation showing it, because whenever you ask money back from CRA, you have to understand that they always want to make sure that you have the solid documentation for it. As soon as you
Mhm.
miss documentation, they're not going to give it to you.
Definitely, a very valid point, right? So there's another question, like, on the same, like, somebody who purchased a property, for example, 500,000, just take an example of that.
Mm.
And in 2015, the prices went to millions. So after that, they refinance it. So
Mm.
this means the current mortgage is at 800,000. So there is the 300,000 equity they took. They use that money to maybe, buy another property.
Mhm.
Now they're selling the original property, which is like for 800,000. The mortgage is 800,000. They're selling for a million. So do they need to pay capital gain or whatever business income on half a million or only on the 200,000? Because the initial purchase price was only half a million, 3,000 they refinance it. Do they supposed to give tax on half a million or it's only 200,000?
I wish it's $200,000. There is no, it's not like that. You already made the money. You just withdraw from your piggy bank a little bit too
Yes.
early, and that's the
Yes.
beauty of real estate. But the reality is that the capital gain tax is always calculated on the original purchase price plus any capital improvement that you've made, and the closing costs as well. And then we take that million minus all the costs associated that's with selling. So the realtor fee, the legal fee, mortgage
Yes.
penalty, you subtract that, we have a net sale price, and then minus your original purchase price plus any capital improvement and all regional closing costs, that delta
Mhm.
is where you would have to pay capital gain tax on. Unless,
Definitely not.
yeah,
Mhm.
unless you live in it for a number of years, and that's a different story. Then we prorate
Okay.
again.
Definitely. So if you live till 2018, maybe no, then the remaining years you have to pay the taxes. Very valid
Yep.
point. So yeah, so there's a question, right? So recently there's a foreign buyer ban that have been introduced. This means like if you don't have any status here, you're non-residents, whatever, right? So you're not supposed to buy property in Canada for next 2 years. But
Mm.
obviously there are exemptions on this. Let's say you have or you are on work permit, and I'm just reading the regulations. Like in the last 3 years, out of 5 years, you have filed those taxes, right? So there are assumptions on that. So specifically, these are on the work permit people, right? So what are the other things we need to talk about? Is there any assumptions we have? Somebody who doesn't have a status here, they are on work permit. Maybe they came as international students, they went to work permit. Is there any other sort of assumptions that they can utilize so they can enter into the real estate market?
Well, as far as I know, this is not an area that I actively practice on,
Yes.
just because we are
Yes.
not the closing lawyer. So the closing lawyer
Yes.
is the person that determine if these rules would apply. As far
Okay.
without looking into taking up all these law, as far as I know, as long as you have some sort of like the exam, there are two things, right now the 2 years is being imposed. You cannot buy at all, and previously there
Yes.
is the Ontario added speculation non-resident
Speculative tax.
speculation tax. So to get the speculation tax back to you, you just have to become a resident, permanent resident, or get a job here, get the proper status within 2 years, that you would be able to apply to get some of that money back, assuming you're using it as your primary residence, not using it as a rental. So
An
that is
investment.
still in place. But in terms of properties that are owned right now, from now until the next 2 years, one thing is don't
Yes.
buy, maybe have, these people should buy, if they are interested, buy new construction homes rather than just buying existing home. That's one way to get into the market,
Yes.
because the expected closing day, as long as it's beyond the 2 years period, you would still be able to close them. Another option is really partner up with someone who has a local status,
Yes.
and do the purchase in accordance to it. Now, is it completely legit? You have to really check with someone who knows this area of tax, and a lawyer to exercise that precaution. It may still not be legit, so something to be considered.
Definitely. So now, this was about we talked about first-time home buyers, investors. This is more about the real estate agents. So recently, in Ontario, they introduced PREC. So
Mm.
most of the time, the people will ask question, right? So shall I, take at whatever the commission coming on my personal name, or should I open a PREC? What are your recommendations on that?
So similar to similar to what I mentioned earlier, when you asked me if someone should set up a corporation, one thing with realtor is that um,
Mhm.
it really goes back to how much money you need in relate for your personal needs. So compared to how much money you earn. So let's just use an example to explain. Let's say someone met grows about $220,000 annually and
Yes.
has business expense of 70, so that person net so
150, let's say.
150,000, yes.
Mhm.
So
Yeah.
150,000, if he doesn't set up a corporation, he has to pay about $45,000 of tax, personal tax. Okay, so um, so 150 minus 45, let's say it's roughly around
Hundred.
$100,000 left.
Mhm.
Now,
Mhm.
if he needs that $100,000 for his whole family to spend and do everything, it is what it is. There's no point set up the corporation. Now, if he doesn't need that 100,000, let's say he only needs 60,000, then there
Mhm.
is a point to set up a corporation because corporation only pay 12.2% tax. And as long as
Okay.
there is something left in the corporation to do other thing, invest or buy mutual funds or buy another property, then it makes sense to set up a corporation. The key here is how much money you net from your business after tax and how much you need for personal spending. If you need the entire 100,000 in our example, then there is no point setting up the corporation. But if you don't need the entire $100,000, you only need $60,000, that additional $40,000 would then be left in the corporation and pay less tax.
Mm-hmm. Yeah, no,
I
no,
know
makes
it's not
sense,
an
right?
easy
So
answer.
yeah, no, no, it's good, right? So it's all about how you basically structure it. So in the long-term vision. So there's another question, follow-up question on that. People say like, if you have a practice, you cannot do any real estate business, anything inside that. It's only for taking commission. But here we talked about we can use the retained earning to do investments or side hustles. How that structure will work around?
So your practice is allowed to do other business. It doesn't say that you're not allowed to do other things. It gets a little bit complicated because the law, the legislation is such, it's poorly drafted, very poorly
Okay.
drafted that it provides so much confusion. But the reality is that to avoid all these, just assume that, okay, the practice is only for earning income. And then
Yes.
another way to transfer income, like the net income over to, is to invest in a separate corporation. So by having the corporation, a second corporation just used for investment, you can also choose to have your lower income family members owning shares of that new corporation, and thus allow
Oh,
this whole structure to essentially split the investment income with your lower income family members. So you're not splitting it directly with them, but indirectly with them. And to set something up like this, you have to talk to an accountant specialized with doing all these type of structure. Otherwise, one misstep would cause attribution, and it would then be attributed back to you, the high income
definitely.
earner.
As per our discussion, there's an option, right? So basically, you can some sort of this can be a hold go, and then it's giving a loan to a secondary
Yeah.
subsidiary, and then this can be used to do the investments.
Yes.
Okay,
Invest
so
and
that
do
that
everything. Hmm.
makes sense, right? So now that's a good point we are talking about, right? I think we covered most of the things, right? So are related to real estate agents. Uh, yeah, definitely, right? So downtown zero doesn't have. So yeah, so there's another question that's coming up, right? So as of now, you can see that we are in sort of a down market. Maybe it's for real estate agent or maybe for any business owners, but there are HST that is due, or there's taxes that are due, because obviously what happens is corporations overspend. The market was totally different way back. So now the things are due here. So can we do some sort of a negotiation with the CRA and extend that payments? Is it a possibility?
So you have to do the filing. Okay, so let's just step
Okay,
back.
done.
The filing has to be done on time. There's no
Yes.
negotiation whatsoever. Now, typically, CRA would allow you, once you file, to call in and make payment plans
Okay.
arrangement. Now, I'm not saying that like they are not going to waive the interest charge on it. You're still being dinged on the interest, but you're allowed to pay it over the next period of time, and you have to honor it. The moment that you don't honor what you commit to, then you get you like they would demand their payment immediately, and then you lose the ability to pay it in multiple payment. So those would be the options available. So if you have, for example, if you have a lot of losses, depending on your particular situation, it may be worthwhile to make sure that you file those on time or as soon as possible, as soon as the year end wraps up. And those losses would then be carried back to the previous year's gain, and you would be able to lower your tax liability from previous year.
Definitely. So there's an option, but you are supposed to file it. That's very important, and then you can negotiate with the CRA based on the terms that you have. No, that's very valid point, right? No, it's a good discussion we are having, Jerry, right? So I think we can talk more about the accounting thing. It's such a wonderful topic to discuss about. So
Yep.
any we haven't talked about actually for foreigners. We didn't haven't talked about the work permit guys filing the taxes, like the people who don't have the status here. But thanks for joining in. Any last conversation, any last thoughts you have?
Tax is not as complicated as it thinks, and it's not a bad thing to have. If you have to pay tax, that means you're making good money. So don't look at it so negatively. I know it sucks to pay, but it's not always negative.
Thank you, thanks, Jerry. And then where people can follow you? I know do you create a lot of educational content, where they can get more insight about you.
So you can follow me on my blog post on my website. I do a weekly blog post at realestatetextips.ca. I also do a weekly YouTube video on my YouTube channel. And if you go to youtube.com/realestatetextips, that would be me. I mean, I'm also on Facebook.
Thanks, Jerry, for joining in. Such a wonderful conversation. Till the next video. Bye bye from our team. Thank you.
Thanks, Mandeep.